Hello, everybody. It's Professor Reiko here. We're continuing on in our earnings per share chapter. So, if you go back and look at the prior videos, what we were doing, we're walking through all the dilutive securities. We did the actual accounting for all of them. Now, what we're doing is switching gears to the second half of the chapter where we would focus in on earnings per share. So, we have basic earnings per share and we have dilutive earnings per share. So, we're going to start with basic. All right, so if we read up here at the top, the earnings per share reflects the income earned by each share of common stock, right? So a capital structure is simple when it only consists of common stock and no dilutive securities that would lead to potential dilutive common stock. So looking here, this is kind of an important thing here, and I'll say this a lot over the next several videos. Basic uses actual transactions or events. Okay, so when we're dealing with basic and dilutive earnings per share, basic is your actual EPS. All right, so basic is the actual EPS of the company. It's based on everything that transpired during the year. When we switch gears and do dilutive earnings per share, what we're going to do is, I typically say dilutive is just hypothetical. Okay, so dilutive earnings per share will be lower than basic. And what we're doing is we're showing our shareholders how low earnings per share could be if all of our potentially dilutive securities, like the convertible bonds, convertible preferred stock, options, restricted stock, all that, if they're all exercised or converted, how low would it make earnings per share go? Okay, so basic is actual, and then when we switch to dilutive, will be strictly hypothetical. Okay, so let's focus in on basic first. So here's our basic earnings per share formula. So it's income available to common shareholders. And so if you look down here, that means we're going to back out. So it's net income minus our preferred stock dividend. All right. And then also, so we have our dividend is the main thing on the numerator we keep up with. And our denominator is weighted average shares outstanding. Okay. So remember, outstanding and issued are different. Okay. So, if we need to go back and look at the equity chapter, some of those videos where we talked about that, make sure you do that. But outstanding is different than issued. All right, so when I teach earnings per share, I will typically refer to the numerator and the denominator effect. All right, so the numerator is this paragraph here, and the denominator is this stuff down here. All right, so I always tell my students, when you have an earnings per share problem and you're starting with basic, you need to first make sure you understand, like for the numerator, you need to ask yourself, is there preferred stock? And if there is, do I need to subtract the dividend? Okay, and on the denominator, you need to say, are there actual share transactions during the year that affect the number of shares outstanding? If so, I need to calculate the weighted average shares. All right, so let's read this paragraph here on preferred stock. All right, so if you look back in the equity chapter, we talk about cumulative versus non-cumulative preferred stock. All right, so remember, cumulative means if we do not pay the preferred shareholders the dividend this year, we have to make that up in the future. Okay, it accumulates over time. Non-cumulative means if we don't pay them, it doesn't matter. We don't have to make it up. All right, so cumulative preferred stock should subtract, if it is cumulative preferred stock, we should subtract the preferred portion. And notice here, regardless of whether they paid it or not. All right, if they're non-cumulative, then they have to be declared during that year to be deducted. Okay, so that's the difference. All right, and the reason being is if you think about cumulative, let's say we don't pay a preferred dividend for 5 years. And then in year 6, we're going to make up the prior 5 years plus this year. If we wait to subtract that, we'd be subtracting 6 years of preferred stock dividend from net income in the numerator of our earnings per share calculation. And that really skews our comparability across years. So to better make it comparable over years, we subtract the cumulative each year. Okay, the non-cumulative only if it's declared or not. So that's your main rule when you're dealing with basic earnings per share. On the denominator side, we have weighted average shares outstanding. All right, so I've kind of set this little chart up here, and then down here at the bottom, I'm going to write in a little table how I typically calculate this. The Spiceland book does it a little bit different than this, and I'll kind of point that out. I prefer this method over the Spiceland method, but they're each, are going to get you to the same answer. All right, so and it's always important, if you're in the Spiceland book and you like this way better, you're going to get the same answer. You need to do which way you're more comfortable with. So that way, come test time, it's easy for you to get the correct answer. All right, so let's walk through what's going on here. We've got issued 25,000 shares for cash. Okay, so if we issue, that means our issued and outstanding goes up. All right, so that would bring our new total to 125,000. All right, and then we purchase back 23,000 shares. Okay, that's us buying back treasury stock. So remember, that reduces the outstanding amount. All right, and then we issued 80,000 more for cash. So that brings my total up to 182. Okay, so that's the transactions for the year. All right, so now let's come down here and we're going to set up a table for weighted average shares outstanding. All right, so when I'm setting up these tables, the way I like to go about doing it, and come test time, this stuff up here, I would never write it out like this. This will be kind of the given information. I would go straight to what I'm about to do right here. But I think the first couple of times I walk through it with my students, I like to really lay everything out. So I kind of did it the same way here in this video. All right, so I set up a table. It says dates outstanding. All right, and then I'll have a column for shares outstanding. And I'll have the percent for the percent of the year, or I guess it's actually a fraction of the year the way I write it, and then I have weighted average shares. All right, so we just break things down by the fraction of the year they're outstanding. So from 1-1 to 3-1, it was just the beginning balance. All right, nothing else happened. All right, our first transaction's on March 1st. So that's 2/12 of the year. All right, and then on March 1st, we issued some more shares, and that stayed the same until 8/1. So we had 125,000. All right, so that's 5/12. All right, and then from 8/1 to 12/1, this is after we purchased some back, so we had 102 outstanding, and that's 4/12 of the year. And then from 12/1 to 12/31, we have 182,000. All right, and that's 1/12. All right, always do a quick check. You don't have to write this out, on the test, but just make sure that, yeah, I've got 7 plus 4 is 11, 12. I've got 12/12. Okay, so all we do here is multiply across 16, 6, 6, 7. This is 52,083. This is 34,000. And this is 15,167. All right, so that ends up being 117,917. All right, and this would be our denominator in our calculation of earnings per share. Okay, so we've talked about that. So when we're dealing with basic, the things you have to ask yourself, is there preferred stock, and do I need to subtract the dividend from the numerator? All right, and the second question is, are there actual share transactions during the year that affect shares outstanding? If so, I need to weight them, okay, for the percent of the year they were outstanding to get my denominator. All right, so the way the Spiceland book does it, they would take, all right, so these 100,000 shares, they were outstanding 12/12 all year long, and then we added 25,000 that were outstanding, so that would be 10/12 of the year they were outstanding, and they would go about it doing it that way. Okay, so that's just something to look into if you're doing the Spiceland book. That's kind of the approach they take. I think this table over here is much easier to walk through, but that's just personal preference. So, obviously pick what you like the best. All right, so that's our basic earnings per share. So what we'll do, I'm going to do one more weighted average shares video when we add in a stock dividend or stock split and talk about how we handle that. And then we'll move into our dilutive earnings per share. All right, so I hope you're enjoying this. Please like the videos and subscribe to the channel, and definitely share it with your classmates. Hopefully it will help them too come test time. All right, I'll see you next time.